You're listening to the Option Alpha podcast from optionalpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at optionalpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again from optionalpha.com, working every single week to make this the most popular investing podcast offered online and in iTunes because it's based on one thing and one thing only, and that's helping you guys make smarter trades. So again, thanks so much for tuning in today. And before we even kick this off, I got a lot of comments recently, and I anticipate getting a lot of comments on today's show because we're going to really be literally blowing some stuff out of the water here as far as what we're doing in backtesting and some of the insights that we have. If you have not given us a review or rating on iTunes, please do that. I talked about in show 74, which is the one right before this, how we literally rejected an offer for $15,000 a month for advertising on our podcast deliberately because I don't want to run our business that way here at Option Alpha. And so the best way that you can help support me, if you like what we did in doing that, is to give us a rating or review on iTunes. It's literally the best way to get the show into the hands of other people who are just like you. So again, in today's show, we're going to be going through this portfolio drawdown stats from 44,801 backtested option strategies. And no, that is not a typo. That is a legit number, a number of backtested option strategies that we have. And I'll go through that here today. We're not going to go through every one, so don't worry about it. It's not going to be a 17-hour show going through all these. But the reality is that we are literally blowing stuff out of the water with the amount of research and backtesting that we're doing. I mean, I don't care what other company, service, website you go to and listen to. What we are putting together here at Option Alpha as far as our backtesting research and software and capabilities is light years ahead of what other people have. And I'm really so excited about it because it's literally going to change not only the dynamic of how I trade a little bit, but also some of the insights that you guys might gain and how you might trade in the future. So I'm really excited about it, and we'll get into it here in today's show. Now, the first thing you have to understand is that this particular subset of our backtesting was done in 10 different ticker symbols. And it was really mainly to get a broad breadth of different ETFs. So it's just ETFs, SPY, FXE, EFA, FXI, USO, GLD, EWW, TLT, IWM, and QQQ. Okay, so again, those 10 major ETFs, and we got everything in there from the euro and emerging markets and Mexico and gold and oil and bonds and technology and small caps, large caps. We got everything in there and have summarized all of this information across those different backtests. Now, you might be asking yourself, okay, well, how do you even still get to 44,000 different backtested option strategies? Well, we took the baseline from this test as all short strangles. So just pure premium selling, and everything from selling short strangles $10 out 10 days out as a weekly contract, or on average 10 days out, all the way out to like 80 or 90 days out in most cases. So every iteration among there, so 10 days out on average, 15, 20, 30, 35, 40, etc. And then we did tons of iterations between there. So you guys have probably noticed in most of our podcasts that we've been doing over the last couple months about all these backtesting, like little mini case studies. We tested everything from selling options at a 10 delta on each side, at a 15 delta on each side, at a 20, a 30, etc. Then throwing in all these iterations of this stop loss versus that, of that profit taking level versus this one, of no IVR filter versus an IVR filter. And you can quickly see how the number of tests that we have to run with our software multiplies very quickly every time we introduce a new component or new element into that testing framework or that backtesting universe. So that's really how we get to, in today's example, we're going to look at numbers from 44,801 backtested option strategies. Now, of course, there's hundreds of combinations. And so what I'm going to try to do here today is really get to the heart of really what I want to get across today. And that's talking about the concept of, or the expectation of, having a portfolio drawdown. Now, I go through this on this show on purpose, not only because we've recently been through a portfolio drawdown ourselves, not only through after the election and like the month and a half or 2 months after that, we went through about a 2% portfolio drawdown, which is really nothing to sneeze at. I mean, like in the grand scheme of things, like it's not a big drawdown by any means. I mean, we definitely lost a couple $1,000s, on trades that went against us. The market went really, really high, very fast. Made huge moves, kind of 2-3 standard deviation moves. But overall, we made adjustments that kind of help reduce risk. We've got all those videos posted for members. So all the archives and history is on the website for sure, kind of going through that whole process. But in that during that time period, what I always see people who bail, right? And they bail because they get afraid and they lack patience in understanding that this is part of the system, part of the process. You are going to have drawdowns. You are going to go through times where it feels like, not that it is, but it feels like you can't win on a trade. And believe me, I've gone through those times, and I've gone through times like we're also in right now where we have not made a losing trade in gold all year. And we've had that streak, kind of mirror the streak that we've had, over the last 2 months of having, 2 drawdowns in those months. And so I want you guys to understand conceptually what a portfolio drawdown looks like on average and why it's not that bad. Like when you break it down into the components and pieces, you're going to have a portfolio drawdown and you can recover and it's not going to be that bad. In fact, you should expect at some point over your trading career to have a decent portfolio drawdown for whatever case it is. And so hopefully doing this show today and kind of bringing forth a lot of these stats helps prove some of that concept and helps at least give you a level of confidence in understanding that you can trade through these situations and still do really, really well. Now, one thing I want to mention before I get into this is, again, with our backtesting software, the software and the computers don't care what's going on in the market. They don't care what's going on in political scenes or this or that or the Fed or whatever. It's literally making as many trades as it can that fit the parameters that we set up for each of these backtests. And so what's great about this is it gives you context of how you can do or how a system could do over time on average, given just a blanket set of parameters and really not worrying about everything else. See, like everyone's too worried about the election or this or the Fed or that or the economy or, real estate. Like everyone's worried about too many different things. It's just a game of math. And that's why, like I recently said, when we went through the drawdown last month in our portfolios, I said, look, this is part of the process. And this is why I record these videos and show these videos even when I go through a drawdown, because I want people to understand that, one, I'm not afraid of showing you guys if we have a losing month or a losing streak of months. It doesn't matter. But over time, I know we will be on the right side of the numbers, the right side of volatility, the right side of win rates and annual returns, etc. I know that math to be true. I just have to show it to you guys so you guys understand it. All right, so here, let's get into it here and really kind of cover some of the meat and potatoes of what we're talking about today. And again, if you guys want to see some of these numbers in graphic format and download our transcript here and the show notes, you can definitely do that at optionalpha.com/show75. That's just the number 75. Go over there. You can download the show notes and keep these with you, forever. So here's the deal. 44,801 backtested strategies. The average drawdown, and these are all kinds of different strangles, right? So I'm just going over the broad averages right now, and we'll dig in a little bit deeper. The average drawdown at any one point over all of those was 13.88%. Not too bad, actually. I mean, like when I saw that number, I said, I thought to myself, like, actually, I kind of expected it to be more. Like an average drawdown over any one point in time. And most of these data that we collected was about 10, 11 years old. So over a 10-year period, you're looking at an average drawdown of about 13.88%. Now, I would say that if you have traded stocks at any point in that time period, you've had a drawdown of way more than that. In fact, just this month, some stocks have had a 15 or 20% drawdown, right? Just single stocks. So to have any one point where you had a drawdown and it was average of 13.88%, honestly, not too bad. Like, I think that that's definitely in the wheelhouse of what it should be, right? And that's over the course of like any one period of time. So top to bottom, right? So you could be 2%, to get to 13%. You could have a long streak to get there. It could happen in 1 month in different trades. But largest move top to bottom in your equity curve was 13.88%. The average time to recover, and this was interesting. So we went back and we said, okay, from top to bottom, and then all the way back up to get back to square one, how long did it take from the bottom end of your portfolio curve, from the worst day that you had, the biggest point of drawdown, to getting back to square one? If you got back to square one, how long did that time take to recover? Now, on average, that time took about 601 days. That's 1.65 years. So the reality is that if you have a drawdown, you're not going to recover overnight. And again, that's acceptable. We should accept that as realistic, smart, educated investors, that if we have a drawdown, that we're not going to magically recover that drawdown overnight. It might take a little bit of time. when you actually strip out, because this is kind of interesting, but when you strip out most trades that didn't actually recover, so they went through like really bad strategies where you're, taking profits early, and we'll talk about this, or taking, using stop losses, etc. When you strip those out, you actually end up with just about like 1.2 years of recovery time for trades that should be profitable long-term. So a trade that you should get into that has a positive expected outcome, high win rate, etc., not using a stop loss, you end up having like a little over a year of recovery time. So again, not too bad, right? I mean, and that's top to bottom, and that's recovering all the way back around. So again, for a 10-year period, if you look at a 10, 11-year period, if 2 of those years you're recouping that, and 8 of those years you're not even doing anything but, making money and off on a slow, steady upward equity curve, I think it's pretty decent. Like as far as, I'm not too surprised with those numbers on average. Now, of all these trades, because I think it's important to mention, of all of these trades and all the iterations among these trades, the average win rate over all the strategies that we tested was 70.38%. So this is in the wheelhouse of a 70% probability of success system. So if you're targeting 70% probability of success like we are, this is all totally in the wheelhouse of what you should expect over time. About a 13%, 14% drawdown at some point, top to bottom. That doesn't mean that, you couldn't be at the top of a peak and you lose some money and then have to grow back up, right? And then about 1 to 1.5 years of recovery time. And again, I'm just saying this because you guys have to understand the context of all this. And this is helpful for me to reinforce because I've felt some of this and see some of this over time. And I just tell people like, hey, it'll come back around, or you just have to keep trading, or, keep playing the odds. But now we've got numbers to actually say, okay, well, this is how long it might take to come back around, or this is, how far down you might expect a drawdown. But this is still a 70% win rate success system over time. The other number was the average annual return of all of these strategies. Okay, so this is important. So if you're having a drawdown, what's the average annual return? Well, the average annual return was 12.18%. Now that was across everything. That was across strategies that we might not even trade because they're not optimized, right? We just tested everything and said, okay, throw it all in the pot. Average annual return, average win rate, average drawdown, average time to recover. The annual returns was 12.18%, which means you're still blowing the market out of the water on an annual return basis, even though you might have a drawdown, and even though it might take 1.5 years to recover from that drawdown, and you're still winning at 70%. So look, folks, I can't drive this point home enough. The numbers are the numbers. They work out. And so you might have a drawdown this month, or maybe, and some people might even go through a drawdown for 6 months. I've never been through a 6-month drawdown. I don't know how to recover from that, but I'm saying I've never been through 6 consecutive months of drawdown, right? We've had 2 months here where we went through drawdowns, and then we might have a winning month, right? And then we might have maybe a drawdown, then 2 winning months. You don't know when they're going to happen, but you know it's going to happen. And so you just have to be prepared for it. All right, so let's shift gears here, and I want to talk about not only some of the best ones, but also some of the worst ones, because I think it's really important to bring some context in here. Now, obviously, we couldn't, dig in too much here in just this, podcast and doing this show for, about an hour or so, as far as every individual's trade and every little iteration, but just conceptually, what we definitely noticed in kind of averaging out different groups and segments within this is we definitely noticed that the largest drawdowns were in all strategies that had 1, 2, or 3x stop loss levels. No surprise here. In fact, we talked about this numerous times in other podcasts. We talked about this basically in show number 67, where we debunked the stop loss myth and showed you 10 different backtested option strategies and how they performed using a stop loss versus not. So if you haven't listened to show 67, go back and check that out. But in almost every case where we saw the largest chunk of drawdowns were when you were using stop losses. Now, I think this is hilarious. I really do. I think this is hilarious because what people are usually taught is that stop losses prevent losing trades. And I see this all the time. I get hundreds of emails every month by people asking why didn't we use a stop loss in this example? Why didn't we cut bait and run? Because the math proves that creates more losing trades over time, right? Do I like losing money? Of course I don't like losing money, but I know if I use a stop loss, I end up losing more money. It should be called a loss creating level. When you use those orders, it should be called loss creation because that's what you're doing. You're creating more losing trades. With those stop loss orders, we average all of those orders. The drawdowns for strategies that use any type of stop loss had a 28.95% average drawdown. Okay, so compare not using it, right, across the board and then using it. So like it's average in there. So just using a stop loss order, your average drawdown was almost 30% on average, right? And that's hundreds of thousands of different trades that we looked at. The time to recover when you use the stop loss was 913 days on average. That's 2.5 years. That's almost double the time it takes if you didn't use a stop loss. So again, I don't know any other way to like tell you guys this or prove you this other than to show it on the podcast and talk about it here. But using stop losses dramatically reduces your win rate, dramatically reduces or increases the drawdown and the time to recover. It's just not a good idea. The average win rate when you use the stop loss, as we all kind of know here, even with trades that initially should be 70%, right? Because their trades on average across the board were 70%. When you just siphoned off and looked at the subset of trades that use the stop loss, your average win rate was 57.45%. Incredibly small. Incredibly small win rate because the stop losses are cutting things off when most of the time it could turn back around and not be too bad or not be as bad as the stop loss assumes it is. Now, as far as like best things that we saw, and I think there's two things I want to mention here as far as like best optimal type, strategies that we saw, or best like little subsets. Number one is IVR rank over the 75th percentile or over the 75th rank, however you want to think about it. But IVR over 75. Of all strategies where IVR was over 75, your max average drawdown was 5.48%. So about a third of what the whole back-tested subset of 44,000 trades was. And so what that means is, and this is what we talk about all the time, is that when IVR is really high or when implied volatility is really high, we scale into those positions. We get more aggressive in those positions because the average drawdowns are less, the average profits are higher, the average win rates are higher. We can capture more of our implied volatility edge during those periods. Okay, now they don't happen all the time. And so that's the downside of that, is that it doesn't happen all the time. So you have to, kind of filter in some of the other low volatility trading strategies that might have a little bit higher drawdown, but can generate some consistent income until you wait for those high implied volatility situations. But I thought that was an interesting stat when we just kind of broke out anything above 75 as the entry point had an average drawdown of 5.48%. The other interesting stat that I want to cover is weekly options. Now, I don't think that this is a surprise, actually. So I'll talk about this here in a second, but I don't think it's a surprise. Weekly options on average, and these were options that had a duration or a timeline of about 10 days on average. So sometimes it could be 5 days, sometimes it could be 11 days. It was about 10 days on average. These weekly options had an average drawdown of 2.27%. So again, not too bad. So when you look at what has the lowest potential drawdown, it's weekly options. But what we do see time and time again, and you have to go back in our archives in our podcast to look at it, but what we do see time and time again is that weekly options, although they might have higher credits initially, and in this case, they have lower drawdowns for that, particular testing period, what we do find is that weekly options do not perform as well on a total P&L basis or return basis as a monthly option does over time. So one podcast you should check out is Show 63. We talked about this in depth in Show 63 with other backtested strategies and performance indexes that the CBO has released. Because again, what we definitely see, and our backtesting confirms this, is that weekly strategies, although they generate a little bit more cash upfront per week, over time, they don't win out as much and they don't generate the overall returns that you should be looking for. So what I always tell people is right now, at least, and this may change in the future, depending on how weekly options, grow in popularity and use. But right now, it is much better to trade one monthly contract than 4 weekly contracts and all the commissions that go with it. Right. And so that's what we're really looking at. But now that means you have to understand that you might have a little bit bigger drawdown, but overall, at the end of the tunnel, at the end of the game, you're going to have a much higher P&L trading those monthly options than you are on the weekly side. So again, I thought it was interesting to at least bring up because we definitely saw it that weekly options, shorter durations had shorter drawdowns, but it just makes sense because the market doesn't have as much time to move against you. So overall, hopefully you guys really enjoyed this show. I wanted to get this one out. I think it's going to be a really popular show. Again, if you want to support us here on this podcast, the best thing that you can do is obviously share this with your friends, your coworkers, your colleagues, your family, and then give us a rating or a review. If you at any point today in this show said, wow, that is a really crazy stat, please tell us, give us a rating or review. Let's help get this show into the hands of other people who might need to hear this information and might help them out in their trading. We're all not working against each other. We're all working against the millions and billions of other traders that are out there. And so I think we can definitely carve out our own little community here at Option Alpha to help each other out. And one of the ways that we do that is help spreading the word about what we're doing here on this podcast.
And now our favorite part of the show, Trader Q&A, where we ask a question from one of our current members about options trading. Got a question you'd like to ask Kirk to answer live on the air? Just head on over to optionalpha.com/ask and hit the record button to leave a message. That's optionalpha.com/ask. And now, here's today's question.
Hi, Kirk. This is Robbie calling from the Big Island. Hey, Kirk, I was wondering, how do you calculate the correct pricing on Make a Trade? Thanks so much for everything you do.
All right. So Robbie, thank you so much for the question and submitting it here. The question, like you said, was on correctly pricing trades that are undefined risk or straddles or strangles. Now, this is definitely a hard concept, right? And so we're trying to build more context around this. And so the true answer that I have right now is we don't know exactly what that looks like right now. We're doing a lot of back testing on this to see if there's anything that we can, give you guys as far as like guidelines or, direction on this. And so to say I have a firm, like you have to do this right now, this has to be the way that you price it, would be ignorant of me and be misleading of me to say. But I do think we'll get very close to that point here in the future as we do more back testing, as we've seen from kind of this subset. What I do believe is that any level of premium selling is eventually going to work over time. And we definitely saw this with 44,000 different variations of selling premium. It definitely works over time on average, right? And so what I have done and what I say that people should do when it comes to selling strangles and straddles and pricing those correctly is look at comparable trades at that moment and see which trade just pays the most per unit of risk, meaning how much money are you making and how much margin is that trade requiring or keeping to add to your portfolio. A great show that you can check out is show number 73. So just a couple shows below this show or a couple shows older than this show, we talk about and we go through a bunch of examples of different strategies or strangles that we priced out all at the 70% chance of success level and looked at the premium that they collected versus the margin that was required. And at least at this point, I would try to take highest to lowest from that list all the time. So always looking at different types of strangles, see which one is paying the most amount of money for the unit of risk or margin required, and work top down on that list, right? And so this is something that we do naturally in our Pro and Elite membership for people who are following our trades. I do this all the time. I go through that list. So if you don't want to do that, sign up and, I can send out the trades when I do them. But that's something I would definitely say is important. I think that definitely pricing wise, I think you should look for, trades that are definitely stocks are over $10, but under $100. Those usually end up being, good ranges for straddles and strangles and just getting decent pricing without having, too much margin required. When you start getting into trades that are, a couple $100, the Pricelines, the Googles, the Amazons, it just never makes sense to do the straddle or strangle anyway, because the margin is just so astronomically high. You always want to do those risk defined. So hopefully that gives you a little bit more context, but again, just use total credit versus margin required and work down that list top to bottom and see what you can get. All right. So if you guys enjoyed this little answer to the question, and if you'd like to get your question answered here on the podcast or live on Facebook and Periscope in the future, please head on over to optionalpha.com/ask, click the big red button in the middle of the screen and leave me a private voicemail. There's no software to download or install. It's incredibly easy. And before we get into the closing bell segment, I wanted to let you know how you can get our special podcast freebie today. And that is our 7-step trade entry checklist. So very much like everything that we try to do here at Option Alpha, we're trying to make things simple, trying to give you a compact list of things that you can check before you get into a trade. And so we have this free download. Again, it's completely free and you can get it by going to optionalpha.com/7steps. That's just the number 7 steps, or by texting in the word 7 steps to 44222. So that's just the number 7, then the word steps, STEPS or STEPS to the number 44222 if you're on a mobile device.
Now, now. The closing bell. Find out which stocks we're looking at right now, trades we're making, and hear our game plan moving forward.
All right, so in today's closing bell segment, I want to go through a new trade that we just got into in IYR, and this is an iron butterfly trade that we got into. Now, IYR is a real estate ETF. It's the iShares real estate ETF, so it tracks real estate, and it's actually been on a little bit of a run recently, up from its lows around 72 up to around 77. And so what we're going to do is we're going to start selling some premium here in IYR for January expiration. So at the time that we're doing this video, January expiration is 44 days out from now, and we're going to do a very simple, very systematic iron butterfly trade where we're going $7 out on either end to buy protection or buy wings. So the basis of this iron butterfly trade is the short straddle. So we're selling the at the money 77 call and 77 put in IYR. Now, this is in our wheelhouse of what we generally want to do as far as selling premium and sometimes selling at undefined risk. The reason that we're doing defined risk in this case is because, one, we can get really far out, so $7 out on either end, and buy protection that's not that expensive. So it's a couple dollars on either end to buy protection and reduce our margin requirement. But two, at the time that we're recording this podcast, or I'm recording this podcast right now, I don't know yet what the Fed decision is going to be in December. And so if the Fed decision becomes a surprise, which maybe it will, maybe they don't raise interest rates, what no one is expecting. If it becomes a surprise, then I don't know what the reaction is going to be to IYR and real estate, because interest rates have a really big impact on the real estate market. So I want to do everything risk defined, at least for now, until we get past that point, and then we can do some undefined risk stuff and start trading a little bit more. Now, in this case with IYR, like I said, we're going out $7 on either end. So we're selling the 77 straddle, then we go up to the 84 call and down to the 70 put, buy those options long. The net result is that we have $331 of net credit collected, and we're going to do a couple of these contracts. Now, the probability of success in this trade is just about 60%, so it's a little bit shorter or smaller than our initial target of 70%. But what we do know with our backtesting is that obviously strategies end up winning at a higher rate than their initial probability of success, especially when we start factoring in things like exiting early and IV's overstatement. So the initial probability or the onset probability of success is 60%. I do expect this trade to win much closer to 70% when we introduce things like taking profits early. And even if we let it go all the way to expiration, implied volatility always overstates how far the stock is going to move, which ultimately means this strategy will win much more so than the initial probability suggests. So I know I get a lot of questions on that. So hopefully that was a good little explanation of what we're doing here in IYR, taking in some good premium, totally neutral on the outlook for IYR, starting to build out our January portfolio even more, and continuing to add a lot of trades and short premium.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, so I truly hope you enjoyed today's show. And like I said, got at least one thing out of it that you can apply right now to make you a smarter, more profitable trader and investor. As always, you can get additional resources, links mentioned in the show, and some related video training by going to optionalpha.com/show75. That's just the number 75, optionalpha.com/show75. Until next time, happy trading.